Welcome back. I hope that by now you have been able to identify several candlestick patterns in your charts and recognize the potential that these signals will have in your trading, regardless of strategy that you may end up using. Today we're going to learn the last one of these signals that we cover in TMT. It will be extremely easy, simply because this signal is the exact opposite of the bullish engulfing pattern that we watched in the last lesson. We call this one bearish engulfing pattern. Once you are able to identify these signals correctly with all the parameters that we use in conjunction with these signals in place, then your probability of being on the right side of the trade will increase exponentially. The bearish engulfing pattern is formed when you have an uptrend that ends with a large green candle and the next candle opens higher than the closing of the previous one and closes lower than the opening of the previous candle, thus engulfing the entire range of the previous green candle. There is also the possibility that the uptrend ends up with a shooting star with the green or red body followed by a bearish engulfing pattern, which of course should be red. As with the rest of the candle signals you have learned so far, the bearish engulfing patterns need the stochastic to be in the right position in order to validate the signal. One of those validations should be that the next candle opens in the lower half of the body of the engulfing signal or even below. I recommend you use a stochastic as your alert signal. In other words, when the stochastic is above the 80 area, start looking for your bearish candle patterns, such as the shooting star, the bearish engulfing pattern, or better yet, a combination of the two. A shooting star followed by a bearish engulfing signal. Just like with the bullish engulfing pattern, you have a couple of things to keep in mind. The first is that the larger the last green candle followed by an engulfing large red candle is, then the larger the reversal will be. And two, if the third candle goes above the middle point of the engulfing candle, that will invalidate the signal, pointing out that the bulls are again in control. Hence, if the third candle doesn't open below the middle line of the body of the engulfing signal, just leave the trade. Now, let's look at some examples. This time I chose the CL daily chart because we have seen several examples before in this chart. So here we have an uptrend and we end here with a long wick, but this is not a shooting star yet because the wick is not twice as long as the body of the candle. So this was not a shooting star, but we do have a very nice divergence, and that divergence is confirmed by a candle that is red and that engulfs the previous body of the body of the previous candle. You can see here that it opens above the closing of this candle and it closes below. In fact, in this particular case, it engulfs both, or actually three candles before it. So you can see that you have 1, 2, 3, and this candle is closing below all three of them and open above all of them. So this was a very good signal. Big divergence, and that called for a big move. Then we have another example here where we have a double bearish engulfing. It is double because, well, we have this candle that engulfs this one and this candle that engulfs this one. It happened right at the end of a rally that ended up with what is known as a double top. A double top is nothing more than a rally that drops and goes back up again, but cannot penetrate above the high of the or above the previous high, making it a double top. And if you can see, the double top is characterized by making an M form. See this? That would make an M. Well, when you have a double top, typically means that the trend is reversing, or you are going to have a deeper than normal retracement. In this case, we were reversing trend. So besides that, we have the double top here, accompanied by a negative divergence that you can see here. So you can see the market tried to go back up, but Stochastic did not confirm it, and then we had this engulfing pattern here that was followed by another engulfing one, which pretty much told us that's a great signal to go down. Okay, and last example, well, in this case we are at the top of the oversold, overbought area in the stochastic, and then up here we end up with a candle that actually opens and closes at the same level. This produces a pattern called doji, and basically in our case right now we're interested in seeing that the next candle, the red one, open above the close of this one and close below the closing of this one. So it engulfed the previous candle, or the previous body of the candle. Actually in this case it was going to be very easy because the body was very small. Doji typically means that there will be a change because there is indecision. So, and in this case, accompanied by the bearish engulfing pattern and the stochastic in the proper position, then we had a great signal, particularly when the next day, in this case, because this is a daily chart, we had another engulfing pattern. So this was a very good signal that if you measure it from 107.53 to 102.97 or something like that, this is $5. All right, so I think those are enough examples for you to identify the bearish engulfing pattern, especially once that you are already familiar with the bullish engulfing one. So this one is just the opposite. Now for your homework. First, identify bullish and bearish engulfing signals in your charts using different time frames to verify that those signals are confirmed by the stochastics and or support and resistance areas. 3. Take trades in your sim using all the candle signals you have learned so far. In other words, and don't take only bullish or bearish engulfing patterns, also take bullish hammers, also take shooting stars, take all the signals that you know so far, okay, particularly when they are in combination with support and resistance areas or stochastic signals. And last one, send all your trades for correction. In the next TMT, we are going to be opening the third module, and we will start our third week with moving averages.